Hello, students. How are you, students? Are you ready to attend accounting course? Okay, today's lesson is regarding about the accounting cycle. This accounting cycle is Unit 3 and it is under the fundamentals of accounting. Okay, to start our discussion, let me introduce you objectives of the lesson or the objectives of this unit. At the end of this unit discussion, you will be able to understand the debit and the credit procedures. The debit and the credit procedures. Understanding debit and the credit procedure very important to record business transactions in the financial documents as well as in the journals, also in the ledgers. Therefore, you have to understand the credit and the debit procedures. You also are able to describe how debit accounts and credit accounts are used to record the business transactions. You will be able to indicate how a journal is used in the recording process. How a journal is used in the recording process. What is its usage? And also you will be able to explain how a ledger and a posting help in the recording process. Also you will be able to prepare a trial balance. These are the objectives of this unit. In order to achieve the objectives which are introduced here, the following unit contents are included in the discussion. This unit contains 3 sub-contents. One, introduction to the accounting cycle. Another is double entry accounting system. Another is records the business transactions. And lastly, the unit summary is presented. Before starting, let me inform you some information. In order to understand more about the accounting cycles with the supporting practices, some exercises included from the topics that you have discussed in the earlier as well as from this unit. There are different exercises and these exercises can be practiced. Therefore, I invite you to come to tutorial classes which is arranged in Sodo Secondary High School at every Wednesday and Friday. In this tutorial class, the contents of the subject can be explained not only in English but also it is explained Amharic also, because Amharic is the national language, but English is the medium of instruction. Therefore, we are not all I plus you native speakers of English. Therefore, it matters in explaining the contents of the subject matter. Therefore, Amharic language can be also in American language. I can explain for you to understand more. Therefore, if you want, come to tutorial class. Otherwise, you can leave. Okay. Let us start from the introduction to the accounting cycle. Let me introduce. The key activities of accounting process, as you know, are identifying, recording, and communicating the business and transactions. These key activities are shown by the accounting cycle here in this unit. These key activities, because these key activities are also the portion or the part of accounting cycles. The recording of transactions is the process of capturing financial data relating to the business activities and operations in a systematic and structured manner. The main purpose of the recording transactions is provide the accurate and the up-to-date information about the financial position of a company, and to maintain the accurate and the complete records of financial transactions. In Unit 1 and Unit 2, you discussed identifying and capturing the business transactions in the financial documents and the types of documents also, theoretically. In this unit, you discuss more practical and the efficient recording methods that most companies use. Meaning of the account cycle. First of all, you have to understand the meaning of the account cycle. What is accounting cycle? How can you define accounting cycle? It is the accounting process that begins with analyzing the identified transactions and journalizing those transactions, then ends with the preparation of post-closing trial balance, is known as accounting cycle. Some steps in the accounting cycle are as follows. Not some steps, but all the steps in the accounting cycle are as follows. First, analyze the business transactions that you have identified. Then record in the source documents and journalize transactions. Journalize means record in the journals. Then post to the accounts in the general ledger. Post to the each account in the general ledger. Then prepare an adjusted trial balance from the ledgers. Then assemble and analyze adjustment data or adjustment entries. Then prepare worksheet. Here preparing worksheet is not mandatory, but it is an option. Therefore, to simplify the work or activities before preparing financial statements, you have to prepare worksheets. This worksheet preparation is optional. And then journalize and post the adjusting entries. Then prepare adjusted trial balance. Again prepared. Then prepare the financial statements. Here financial statement is prepared from adjusted trial balance, not unadjusted trial balance, but adjusted trial balances. Therefore, preparation of financial statement follows the preparation of adjusted trial balance. Then journalize and post the closing entries. Closing entries are always took place at the end of the accounting year. Then lastly, prepare the post-closing trial balance. Therefore, this is the last step. Preparation of the post-closing trial balance is the last step in the accounting cycle. These cycles are accounting process of what? Of one accounting year, not 2 accounting year or 3 accounting year, but 1 accounting year. From the start point to the end point, this is 1 accounting year account process. Therefore, if you understand these cycles, just you captured the accounting knowledge. Therefore, those who want to be an accountant in the future, you must understand the account cycles, because these account cycles took place always in the 1 account year. Then another account year also, it started from the beginning to continue like this. Let us discuss the double entry account system. Here double entry account system is very, very also important in accounting. Here double entry account system is a system of bookkeeping. It is a system of bookkeeping that involves recording transactions in at least 2 accounts with an equal and opposite entry for each transaction. Just in one transaction, at least 2 accounts affected. One entry is debit, another entry is credit, and the amounts of debit entry must equal to the amounts of credit entries, and this is known as double entry account system. in the dual aspects of dual aspects principle of accounting. This system is based on the duality principle just, which states that for every left side entry there must be a corresponding right side entry. Let me give you an example. Example, paid cash 1000 birr for electric bill of the month. 1000 birr for electric bill of the month. Here, this transaction decrease of cash 1000 birr is a right side entry, whereas the increase of electric expense because of payment of 1000 birr for electric bill, then expenses of utility expenses or electric bill increase, but cash decrease for business organization because cash amount is paid from the bank or from the safe just. In any way, this decreases the asset account of the business organization and increases the expense account of the business organization. While cash is an asset account, here electric expense is an expense account. Therefore, the right side entry is expense account and the left right side entry is the cash account and the left side entry is the expense account. In accounting, always left side is known as debit side, right side is known as credit side. Under the double entry system, the dual or two-sided effect of each transaction is recorded in appropriate accounts. This system provides a logical method for recording transactions and helps ensure the accuracy of the recorded amounts and the detection of errors. Very important to detect errors and for accuracy of the recorded amounts. Double entry account system is very, very useful. If every transaction is recorded with equal debits and credits, the sum of all the debits to the accounts must equal the sum of all the credits. Example, let me give you example of more than two accounts that affected in one transaction. Sold Ethio Telecom services in 100,000 birr, of which 50,000 birr is received in cash and the remaining balance due at the end of 3 months. This is an economic event or business transaction. This is the sale transaction. Here Ethio Telecom services given to the customers and they received they sold totally 100,000 birr. From this 100,000 birr they received 50,000 birr in cash now, and the remaining 50,000 will be received after 3 months. Therefore, this is one type of economic event or business transaction. Here, debit and credit accounts affected are, in this transaction, debit and credit accounts affected are cash account, account receivable account, and service revenue account. 3 accounts are affected in this business transaction. Therefore, the effects on each account here, by receiving 50,000 birr, cash is received, 50,000 birr cash is increased. By receiving 50,000 birr, cash is increased, and also the 100,000 birr increase the sales revenue, service revenue. That means service revenue. They sell services. Therefore, they receive this 100,000 totally by sale of services. From this 100,000, 50,000 cash received now. A remaining 50,000 will be received in the later time. Therefore, cash is increased by 50,000. Another collectible account, that means account receivable. Account receivable means collectible in the future. Also increased by 50,000. The remaining amount is 50,000, and totally the service revenue 100,000. Therefore, here cash and account receivable, both accounts are debit accounts. Debit accounts, where the service revenue is the credit account. The total of debits 50,000 plus account receivable 50,000, together 100,000, and the credit account service revenue is 100,000. Therefore, the totals of debits must equals to the total of credits. Is explained like this. Let us discuss the nature of accounts. What is account by meaning? What is account? Account is a record of increases and decreases. It is a record of increases and decreases in a specific asset, liability, or equity items. Just this is an account. The number and the type of accounts are not the same for companies. Not the same. They differ company to company. The number of accounts depends on the amount of detail management desires. Most companies have a chart of accounts. In the chart of accounts, this chart of accounts lists the accounts, name of accounts, and their numbers that identifies their location in the ledger. The numbering system that identifies the accounts usually begins with the balance sheet accounts and follows with the income statement accounts. The account has mostly two-digit numbers, mostly two-digit numbers that shows their group and their location in the group. Here, their group means asset group, liability group, equity group, revenue group or income group, and expense group. And their location in the group, that is the first located in the first or located in the second, like that. Two digits. The first digit shows that their group. The second digit shows their location in the group. In most companies, for assets, for asset groups, number 1 is given. For liability groups, 2 is given. For equity groups, 3 is given. And for income or revenue groups, 4 is given. And for expense groups, 5 is given. Then 5, if you see or if you observe the account numbers that start by 1, that is asset group. Account number that start by 2, that is liability group. Account number that start by 3, equity group. Account number that start by 4, revenue or income group. And account number that start by 5, the expense group. In its simplest form, an account has a capital letter T shape, and consists of 3 parts. One is a title. That title means the name of account. And 2, a left or the debit side. And 3, a right or credit side. Debit and the credit procedures of accounts. Let us discuss the debit and the credit procedures of accounts. The debit and the credit procedures in the double entry account system are as follows. Debit and credit rule of accounts states that increases and decreases in all liabilities and all equities have to be recorded opposite from increases and decreases in all assets. This is why, because to make the basic account equation, asset is equals to liability plus owner's equity, always balance. Thus, increases in all liabilities are entered on the right or credit side, and decreases in all liabilities are entered on the left or debit side. The opposite is true for all assets. Asset accounts normally have the debit balances, whereas the liability and equity accounts normally have the credit balance. Therefore, the balance side amount for accounts should exceed or equal the non-balance side amount of that account. All increasing accounts for the equity account will have the same increase and decrease side with the equity account, such as the investment by owners, the revenues, gains, retained earnings are examples of equity accounts. These accounts increase side is the credit side, like as the equity account, and the decrease side is debit side, also like as equity. That means for equity accounts, increase side is credit, decrease side is debit. All decreasing accounts for the equity account will have debit side as a balance side, such as the drawing account. Drawing account is a decreasing account of equity account. Expense account also is the decreasing account of equity account. Losses is also decreasing account for equity account. These accounts are the decreasing accounts. These accounts have debit side as a balance side and the credit side as a decrease side. They are opposite to equity. As a summary, assets, drawing, expenses, and losses have the same increase or debit and decrease or credit side. Here, as liabilities, equities, revenues, investment by owner, retained earning, and gains have the same increase or credit and decrease or credit side with the equity. Okay. Recording the business transaction is another subtopic. Recording the business transaction. This is also another account cycle. Recording the business transaction. That means identify the business transactions, then capturing on source documents, then record on the journals. Record business transaction means journalizing. Recording the business transactions is the second key activities of an accounting process. The first key activity of an accounting process is identifying the economic event, then analyzing takes place. The analyzed transaction must be captured by source documents, and then from these source documents recorded in the journals. Journalizing takes place. Entering the source document information in the journal step by step is called recording, or what we call journalizing. Here, recording process includes three steps. One is analyzing the business transaction, another one is entering in the journal, and the third one is transferring the journal information to each account in the ledger. These three steps or process are the recording process. Let's discuss the journalizing business transaction. Journalizing means recording. Before that, what is the journal here? What is the journal? Companies initially record transactions. Companies initially means at the first time record transactions in chronological order in the journal. In a chronological order in the journal. What is a chronological order? A chronological order means the order in which transactions occurred. The order. First occurred transaction recorded first. Then second occurred transaction recorded second. Like that. This is a chronological order. But the first occurred transaction not to be recorded in the second place. The first place take place that the first transaction occurred must take place as first time in the journal. That is known as a chronological order. A chronological order. The journal is referred to as the book of original entry. It is the original because as initially every transactions are recorded in the journal first time. Therefore, it is referred as the book of original entry. For each transaction, the journal shows the debit and the credit effects on specific accounts. Here, entering transaction data in the journal is known as journalizing. Companies may use two kinds of journals. One is a special journal, another is general journal. What is a special journal? A special journal is a journal used to record only one type of transactions. If only one type of transaction is recorded, that journal is known as special journal. Example, all purchase transactions are recorded in purchase journals. All receipt transactions are recorded on receipt journals. All sales transactions are recorded on sales journal. All purchase transactions are recorded on purchase journals. Therefore, here purchase journal, sales journal, receipt journal, payment journal are examples of special journals. Then what is the general journal? General journal is also another book used to record all types of transactions. If all types of transactions are recorded in a journal, that journal is known as general journal. Therefore, companies use two kinds of journals. Every company has the most basic form of journal is called general journal. Every company, just. You can see the format of journal in page 73 of the module. A general journal has 5 columns, just. It has 5 columns to record the date of the transaction, account titles and explanations column, the post reference column, the debit amount column, and the credit amount column. These 5 columns are columns of general journal. The journal is a key contributor to a recording process. It is key contributor to a recording process that it discloses the complete effects of a transaction in one place. It also provides a chronological record of transactions, and thirdly, it helps to prevent or to locate errors, because the debit and the credit amounts for each entry can be easily compared in the general journal. Therefore, it is a key contributor to a recording process. Let us discuss the simple and the compound entries in the journal. In the journal, you may get simple and compound entries. What is simple entry and what is compound entry? Simple entry is an entry that involves only 2 accounts. Only 2 accounts. Example, paid cash 500 birr for telephone bill of the month. Here, only 2 accounts are involved. They are the utility expense and the cash account. Utility expense account is one account, cash is another account. Only 2 accounts are affected, and this entry is known as simple entry. Another one is compound entry here. What is compound entry? An entry that requires 3 or more accounts is called compound entry. The example of compound entry: on July 1, Bole Shipping purchases a delivery truck costing birr 140,000. It pays birr 80,000 cash now and agrees to pay the remaining birr 60,000 on account. Here, 3 accounts are involved in one transaction. The name of the accounts are delivery truck account, that is an asset account, and cash, another asset account, and account payable. This is a liability account. 3 accounts are affected. Therefore, it is compound entry. In a compound entry, the standard format of journal requires that all debit entry be listed before the credit entry. Okay, let us discuss the posting entries to the ledger. Posting entries to the ledger means posting data or information from the journal to the accounts in the general ledger is known as posting. The entire group of accounts maintained by a company is called the ledger. Just group of accounts. In a company there are so many accounts. Therefore, the group of accounts means that the asset groups and the liability groups, the equity groups, expense groups, revenue groups. All these groups, group of accounts maintained by the company are known as the ledger. The ledger provides the balance of each account. The ledger provides the balance of each account, as well as it keeps a series of changes in these balances. Changes means increases and decreases of the account. Companies may use different kinds of ledgers. Here, general ledger and subsidiary ledger, just in general ledger and a subsidiary ledger. But every company has a general ledger. A general ledger contains all the assets, liability, equity, revenue, and expense accounts. These are a general ledger. Some accounts in the general ledger contain control accounts, just control accounts. Here, accounts in the general ledger that require more detailed information about their balance are called control accounts. Example, here account receivable account balance requires to prove what sum of each customer account balances in the subsidiary ledger, and the account payable account balance requires checking sum of each creditors or suppliers account balance. Therefore, account receivable and account payable are known as control accounts in the general ledger. If the total balance of account receivable is not equals to the total sum of the customer's account balance, then there is some errors. Therefore, in order to check the balance of account receivable account, subsidiary ledger of the customer's account must be maintained. And for account payable account, also the creditors account in the subsidiary ledger must be maintained. Therefore, here account receivable and account payable are known as control accounts in the general ledger. For each control account, more detailed information is maintained in a subsidiary ledger. Let us discuss the standard form of account. The standard form of account. In general, account forms are three. One, T-shape account form. T-shape account form. Second, two amount column account form. And the third, three amount column account form. Let us discuss each. T-shape account form is used only for illustration purposes, just for explanation purposes, but not for reporting purposes. The second and the third account forms can be used for reporting purposes, and their difference is the number of columns, just the number of columns. Two amount column account form has 8 columns. 8 columns. That is the date column, the item column, post reference column, debit column. Again, another in the right side also date column, item column, post reference column, and the credit column. Therefore, right side and the credit side. The first date, item, post reference, debit are the left side column. The another date, item, post reference, and the credit are the right side column. Therefore, totally 8 columns are available in the two amount column account form. Three amount column account form has 3 amount columns. 3 amount columns and another 3 columns also. That is the date column, the description column, post reference column, debit column, credit column, and the balance column. You can refer this illustration of general ledger and the 3 column account form on page 76 of the first module. Let us discuss the steps of posting. Steps of posting. Posting has steps. The procedure of transferring journal entries to the ledger account is called posting. What is posting? It is the process of transferring the journal entries which are recorded in the journal to the ledger account in the general ledger is called posting. Posting is the third phase of a recording process. It is the third phase. The first phase is analyzing. The second phase is recording or entering in the journal, and the third phase is posting. Therefore, these 3 phases are the process of recording. Here, posting is the third phase of a recording process that accumulates the effects of journalized transactions into the individual accounts. Posting and opening entries or balance sheet item have different steps from posting the journal entries. Take care here. When we post an opening entries, we follow 5 steps. However, when we post journalized transactions, we follow 4 steps. Let us see these 4 steps. 1. Enter the date, the journal page number, the debit amount shown in the journal in the appropriate columns of the account debit is the first step. Then return to the journal and in the post reference column of the journal write the account number of the account to which the debit amount was posted. That is the second step. The third step, enter the date, the journal, page number, and the credit amount shown in the journal in the appropriate columns of the account credited. Fourth step, again return to the journal and in the post reference column of the journal write the account number to which the credit amount was posted. Posting should be performed in a chronological order also. That is, the company should post all the debits and all the credits of one journal entry before proceeding to the next journal entry. Posting should be made on a timely basis just to ensure that the ledger is up to date. Timely basis. Okay, let us discuss preparation of an adjusted trial balance. An adjusted trial balance. Here, the recording process holds three key steps. One is analyze the transaction, that is debit credit analysis. Second, enter the transaction in the journal, that is third, post to the ledgers. Then, an adjusted trial balance is prepared from the ledger balance. An adjusted trial balance is a list of accounts and their balances at a given time. Companies usually prepare a trial balance at the end of an accounting period. They list accounts in the order in which accounts appear in the ledger. Debit balances appear in the left column of the trial balance and the credit balances appear in the right column of the trial balance. The totals of the two columns must be equal. The trial balance proves the mathematical equality of debits and credits after posting. A trial balance may also not find errors in journalizing and posting. A trial balance is useful in the preparation of financial statements. That will be explained in the next unit, that in unit 4 we will discuss this preparation of financial statements in unit 4. A trial balance has three columns, that is account title column, debit balance column, and the credit balance column. Steps to prepare trial balance are three. One, list the account titles and their balances in the appropriate debit or credit columns. Second, total the debit and the credit columns. Third, verify or check the equality of the two columns. These are three steps to prepare trial balance. A trial balance is a necessary checkpoint for finding certain types of errors, but not all errors. Errors like only the debit portion of a journal entry has been posted. The trial balance would bring this type of errors or show this type of errors. The numerous errors may exist even though the totals of the trial balance are equal. Errors that can't be found by trial balance. Let us discuss the errors that cannot be found by trial balance. The trial balance may balance even when a transaction is not journalized. If a transaction is not journalized, this is one type of error, but you cannot find such type of errors in a trial balance. A correct journal entry is not posted, for example. This is also another error, but cannot be found by trial balance. A journal entry is posted twice. Sometimes journal entry is posted twice. One entry is posted twice. That is another error, but you can't get such type of error in trial balance. Incorrect accounts are used in journalizing or posting. Incorrect accounts means amounts are given to incorrect account. Such type of errors cannot be found by trial balance. Therefore, a trial balance does not guarantee the freedom from recording errors, and this is its limitation of trial balance. Let us summarize the unit. Let us summarize. Account cycle is a series of steps that business follow to record financial transactions accurately and prepare financial statements. The cycle includes identifying transactions, journalizing them in the general journal, posting to accounts, preparing trial balances, making adjusting entries, creating financial statements, closing entries at the end of an accounting period, and Finally, preparing post-closing trial balance are account cycles. The fundamental concept of double entry accounting or double entry bookkeeping revolves around debits and credits. Debit and credits are used to record transactions in a company's general ledger. A debit entry increases assets and expense, while decreases liabilities, equity, and income. On the other hand, a credit entry decreases assets and expenses, while increases liabilities, equities, and income. Accounts represent the specific items such as cash, inventory, accounts payable, equipment, so on in the accounting system. When a business transaction occurs, it is recorded using debits and credits in these accounts. For example, when a company sells goods for cash, the cash account is debited or increased, while the sales account is credited or increased. At least two accounts are affected, debit and credit. A journal is a chronological record of all transactions before they are posted to the general ledger accounts. Each entry in the journal includes the date of the transaction, debit and credit accounts affected, a brief description of the transaction, and the amount involved. The journal serves as a primary record of original entry. After transactions are recorded in the journal, they are then transferred to individual accounts in the general ledger. The ledger contains all accounts used by a company organized in a systematic manner. Posting involves transferring information from the journal to respective accounts in the general ledger to keep track of balances accurately. At last, preparing a trial balance ensures accuracy before preparing the financial statements. How can we prepare financial statements? You will discuss this in unit 4 for the next class. Thank you for listening attentively.